All right, welcome, folks. Welcome to another episode of Advisor Insider. I'm your host, Jeff Benjamin, Wealth Management Editor here at ETF.com, talking today with Rob Arnott, the founder and chairman of Research Affiliates, based in Newport Beach, California. How you doing, Rob? Thanks for being here.
Doing great. Thanks for the invitation.
Yeah, well, we got a few things we're going to kind of talk about today. One thing is I want to talk about this new ETF, the Research Affiliates Deletions ETF, ticker NIXT. It started trading September 10th. It is designed to track the Research Affiliates Deletions Index, which is, I guess, where you come in. Now, as I understand this, it's holding between 140 and 180 companies, and it is kind of quasi-active. It is basically investing in the companies that are removed from other indexes for various reasons, correct?
That's exactly right.
Okay, how does a company get removed from an index that comes onto the radar screen of this deletions index?
Well, firstly, we've done a ton of research on indexes and index funds, and there's a lot of wonderful things about index funds, but there's a few dark corners.
Mm-hmm.
People think of them as passive. They are, except they also add and drop stocks.
Mm-hmm.
And in the case of S&P, they add and drop stocks based on the decisions of the S&P Index Committee. In the case of Russell, they add and drop stocks based on a formula. If their market cap falls too far, they get kicked out and replaced with companies with larger market cap. In both cases, the market value of the company is a key deciding factor. And the result is something that we've documented again and again. I wrote a paper, S&P Index Additions and Deletions, back in 1986, a long time ago. And I pointed out that deletions generally underperform the index by about 12%, and additions add about 4%. That's an enormous spread. Uh,
Mm-hmm.
and that's because adding a stock, you got a ton of money chasing an index that has to buy. S&P indexes are now about 25% of the market, which means that if the S&P Index Committee adds a stock, Tesla in 2020, for instance, the index funds have to buy 25% of the total value of the company. Who do
Right.
they who do they buy it from? They buy it from active managers, and they buy it from active managers who love the stock because it's gone up and up and up. And so they have to pay a premium. Those stocks replace stocks that get dropped. Why do stocks get dropped? Because they've tanked, they're unloved, feared, even loathed, and are facing fierce headwinds. And so they have to sell 25% of the market cap of those stocks instantly,
Okay.
typically
Right.
the same day. And those have to be bought by active managers who don't want it. So they have to hammer down the price to a point where people are willing to buy it. So one of the implications of this is that deletions from indexes tend to snap back handily, tend to outperform, um, averaged across samples, the stocks that are deleted on average outperform the market by 20% in the year after they're dropped. Now that's heavily concentrated in years of high turnover like 2000, 2001, 2009. But averaged across time, it's still 7%, and it's 28% in the 5 years after they're dropped. So
Mm-hmm.
on average, stocks that get kicked out um, do awfully well. I like to joke that companies that are kicked off an index, uh, we wrote a white paper, Nixed, The Upside of Getting Dumped. And it's a fun paper. So if your listeners want to look it up, they can either Google Nixed, The Upside of Getting Dumped, or Google researchaffiliates.com and get the paper. But basically, most of us have had the experience of being dumped sometime in our life. And you have a choice of wallowing in self-pity for life, or pulling up your socks, getting on with your life, and maybe learning a few lessons along the way. The same applies to companies. When they get nixed, when they get kicked out of an index, they can go on to achieve great failure. or they can pull up their socks, learn some lessons, and get their act together.
Hmm.
And so Dave Nadig, when he learned about this strategy, said it's a cool completion strategy. It fills in the gaps that the index calculators deliberately created by kicking the stocks off the index. And so if you want a full market portfolio, you own the index and the companies that have been kicked off, which is kind of cool. So we have done a lot of research on this. The idea of beating the market by 28% over the 5 years after a stock's kicked off is pretty enticing. And so we also recognized that all of the stocks that are kicked off are deep value stocks. They're kicked out because they're cheap, out of favor, unloved, and have performed miserably. Um, all right. That means that you're selling low.
Hmm.
Some of these companies come back. The most recent and vivid example is Lumen Technologies, which was kicked out of the S&P in March of 23 and kicked out of the Russell Index in June of 23. And um, this past year was up over 500%. Why was it up over 500%? Because in the third quarter, Meta contracted with Lumen, which has a niche specialty in a particular area of AI, and contracted with them to help Meta up the learning curve on that niche element of AI. And so up 500%. If I've done my math right, Lumen will be re-added to the Russell Index in June of the coming year. That's sell low, buy high. And so you don't need a lot of those companies to counteract the companies that, as I jokingly say, go on to achieve great failure. The companies that continue floundering, they're already priced for floundering. So their
Hmm.
downside is not huge. In fact, if they flounder a little less than expected, they can even go up. So you need just a few that regain their footing to create wonderful performance. So when we went back and tested this idea, we found that stocks kicked out of the S&P or the Russell Index over the 32 years from 1991 to 2023, those stocks made you 74 times your money.
What is the holding period for these once you add them to this index?
They're held for 5 years. Now, an important point of clarification. S&P and Russell view the stocks that they delete as part of their intellectual property, and we are deeply respectful of intellectual property. So what we do is we create our own index of the 500 largest market cap stocks and of the 1,000 largest market cap stocks, and buy the stocks that get kicked out of the top 500 or the top 1,000. The performance is essentially identical. Well, not identical. The performance is essentially the same over long periods of time, and the
Hmm.
overlap with the S&P and Russell deletions is 60 to 80%. So it winds up being an elegant way to capture the deletions effect. And ETF Architects was kind enough to launch an ETF based on this in September. And what's kind of fun is they don't have any marketing. We don't have any
Hmm.
marketing. Our business model is to come up with investment strategies and license them to others. So with zero marketing, just about 40 million has flowed into the fund in the first 4 months, which is really pretty cool. That's not huge. We run 150 billion, 40 million is rounding error, but it's fun seeing the idea gain traction without even having wholesalers or marketing people focused on it.
What's the market cap range of the stocks in this NIXT ETF?
Well, think of it this way: the if you're kicked out of the S&P, you're definitely not in the top 500. If you're kicked out of the Russell 1000, you're definitely not in the top 1,000.
Hmm.
Most of the stocks in the portfolio would fall into the Russell 2000. Almost all of them would fall into Russell 2000 value. So the Russell 2000 value index is what we've designated as the appropriate benchmark for the ETF. Um, the index itself has outperformed Russell 2000 value by a little over 2% in the first 6 months of the index.
How are the stocks weighted in this index?
They're weighted equally. Once a year, we return to equal weighting. So right now,
Okay.
Lumen's a 2% weight. By the way, the holding period's 5 years. Um, and that's because when you kicked out of an index, the first year you add about 7%, then 6%, 5%, 4%, 3%. Over the 5 years, it adds up to 28% outperformance with compounding. And after the first 5 years, it becomes a market performer.
Hmm.
So hold for 5 years, or if it's re-added to the index, it's kicked out of our index. The other thing we do is have a quality filter. We want to buy dirt cheap value stocks. We don't want to buy value traps on their way to zero. So we filter out the 20% that are the lowest quality on the list. And that spares us the vast majority of companies that go on to fail. And so that's a nuance. Ultimately, the portfolio holds, as you said, 140 to 180 stocks on average over time. That's broad diversification. That means your average holding is about 0.6%. Lumen is our largest holding. It's about 2%. Now, 2% as your largest holding, well, wait a minute, we're an equally weighted portfolio. The equal weighting is set each time we rebalance in April. And so Lumen up 500% becomes a 2% weight in the portfolio. If it's re-added to the index in the second quarter, which it almost certainly will be, it'll be kicked out for that reason. If it isn't kicked out, it'll be reset back to equal weight. And so there's a willingness to take some gains. And if a loser goes on to lose more, we'll top it up because we're reasonably confident with the quality filters that it's not a value trap, that it's just a dirt cheap stock.
Okay. It's an interesting strategy. I guess it's been 6 months or so. We'll see how it works going forward. But why do you think, Rob, that no one else has done this yet?
With most of what we do in product innovation, that's the baffling question. We were the inventors of RAFI, the fundamental index, back in
Hmm.
2004. All right, what is RAFI? RAFI simply says, why are we weighting stocks by market cap, by market value? If the stock is overpriced, its weight in the portfolio is too high. So you have most of your money in stocks that are destined to underperform. Why would you want to do that? What about weighting stocks based on how big their business is?
Hmm.
Sure, some companies are better and are growing faster, and other companies are worse and are shrinking, but that's already in the price. So the growth companies are only going to help you if they grow even faster than the market expects. The value companies are only going to hurt you if they underperform bleak expectations. So by weighting the company in proportion to its macroeconomic footprint, its footprint in the economy, you wind up having a stable anchor. If the price soars and the fundamentals don't, Rafi will say, thank you very much for that lovely gain. I'm taking some profits. If it tanks and the fundamentals don't, Rafi will say, thanks for the deep discount. I'm topping it up. And so you get a rebalancing alpha,
Hmm.
but also have a value tilt. Growth stocks are systematically underweighted, value stocks are systematically overweighted. Cool idea, fun idea. And it's worked extraordinarily well relative to the value indexes. So if you look at uh, fundamental index all world and compare it with MSCI ACWI value, what you find is that live, this has been
Hmm.
a live index since 2006. Live, it has outperformed the MSCI ACWI value index in 15 out of 18 years.
Okay. Well,
15
all
out.
right. This ETF, we're going to keep an eye on it. And just to let you know, folks, It's the expense ratio is listed at 39 basis points, but it is only charging 9 basis points for the first 12 months of trading. That is through September. So
Mhm.
we will definitely keep an eye on that. It's so interesting. I
Thank you.
I'm intrigued by to see where this goes, Rob.
And
Um,
you did ask why the others hadn't come up with this before, and as with
mhm,
the question is baffling. I
yeah.
don't know why this wasn't done years and years and years ago. I don't know why non-cap weighted indexing wasn't done before we came up with fundamental index. I mean, the only exception that predates that is simple equal weighting, which has its own merits. It's a neat concept.
Yeah.
So one of the things that I find constantly baffling is the ideas we come up with. Why are they new? They're simple.
Hmm. All right, let me shift gears here to the. I want to talk a little bit about the. We got a new president. I don't know if you heard that.
Uh,
It's and
what's
it
the guy's name?
yeah, Donald Trump. Donald
Oh,
Trump. It's
yeah.
his it's actually his second term, but he took a 4 year break.
Oh,
But
good for him.
yeah, so I want to just big picture. We can go as macro as or as specific as you want on this, but what are some of the things that you see or you're anticipating in from an economy and a markets perspective in Donald Trump's second term?
Well, firstly, our base case is that whoever's in charge of the country um, doesn't make nearly as much difference to the stock market as most people think. Um, uh, there are exceptions.
Mm-hmm.
Um, Now, secondly, just for full disclosure, I'm a libertarian, which means I believe in small government, which means most Republicans and most Democrats don't want anything to do with me because they want big government. They just want to control what they're spending on.
Mm-hmm.
So if Trump radically reduces the regulatory state, it'll be good for the economy and good for business. That in turn could be good for the stock market. The stock market has headwinds just based on being very expensive right now. So I look on the stock market as currently priced to give you maybe 5 or 6% returns over the next 10 years. You can get that on bonds.
Mm-hmm.
So I'm not a bull on the stock market. Bear markets happen about every 5 to 7 years. I'd give us 50-50 odds of a bear market in 2025 or 26, um, which is higher than that 15-20% risk that's normal. So I view Trump as having inherited a poison chalice in the sense that the market is expecting great things, and if his skinny majorities in Congress block sensible reforms, then the market's overpriced. Value is cheap. This is one of the
Mm-hmm.
reasons that we launched the next index, because small cap stocks are cheap, partly an index effect. Money pouring into index funds drives up the relative valuation of stocks that are in the index versus stocks that aren't. Value stocks are almost as cheap as they were at the top of the dot-com bubble or at the end of the value crash from COVID. Uh, Almost the cheapest ever. And so if value's cheap and small cap's cheap, then small cap value is really cheap. Um, People often ask, if there's a bear market, do you worry about small cap value getting crushed even harder? Wonderful counterpoint to that is when the dot-com bubble burst from March of 2000 to March of 2002, the S&P was down about 25%. Russell 2000 value was up about 50%.
Wow.
And a deletion strategy beat Russell 2000 value handily in that span. So the notion that a bear market takes no prisoners isn't always true. So I love seeing asymmetric risks.
Okay.
Asymmetric risks are evident. Small cap value is so cheap that even a bear market might not bring it down. And non-US value stocks are so cheap that they represent an opportunity. I see an opportunity-rich environment. The opportunity just isn't very interesting in large cap US stocks or in mainstream bonds.
I'm curious why you're so, I don't want to call it bearish, but definitely non-bullish. 10 years of 5% returns by the by stocks.
Here's the arithmetic. We have a website, Asset Allocation Interactive. And if your listeners Google Asset Allocation Interactive, it'll take them straight to our website. We forecast the 10-year returns on 130 different asset classes, and we do it through a very simple expedient. What's the current yield? What's the long-term historical growth in earnings or dividends or income produced by the asset? For bonds, of course, it's zero growth because bonds are fixed income.
Mm-hmm.
For tips, it's contractually linked to CPI. For stocks, there's real growth over and above CPI. And so you take historical growth, extrapolate it, and add on the dividend yield. Well, the historical growth in earnings and dividends in the US has been 4 to 4.5% over the last century. Wall Street's predicting 12% growth. How the heck are you going to get 12% growth in earnings and dividends if the economy is likely to grow at 4%? It can't happen. And so the result is you have expectations that are wildly out of kilter relative to plausible outcomes.
Mm-hmm.
4% growth and you have a 1.25% dividend yield, that gives you 5.25%. Now, the third component of returns is mean reversion towards historic norms. The Shiller PE ratio, which is price relative to 10-year smoothed earnings. The Shiller PE ratio right now is 38 times earnings. What's the historic norm? About 18. Maybe this is a new normal. Maybe we're going to be at 38 in 10 years. Maybe we mean revert back to 18. Ouch. Or maybe let's split the difference and just assume maybe one happens, maybe the other happens. If you split the difference, you're going back to 28. That's still expensive, but that would bring your 5 or 6% return down to about 3. So yeah, I have a very cautious view on large cap US stocks, especially growth stocks. The Magnificent Seven, I am strongly of the view that Magnificent Seven, the narrative that they're going to change the world is absolutely correct. The market is expecting it to happen fast with none of these companies getting disrupted along the way. And the market is probably wrong about that. So the market is right that these companies are beautiful companies rocking our world and is wrong to price them as high as they do. So I view the growth side of US large cap stocks as particularly vulnerable and likely to have a negative 10-year return.
Okay. One more question on this topic of I guess the year ahead or in your case, the 10 years ahead. Do you expect the Trump policies to trigger inflation that a lot of people are talking about, or I guess a resurgence of inflation?
People talk about tariffs as being inherently inflationary. After he announced his intended tariff policies, the dollar rallied about 6%. Well, that's going to offset half of any 10% tariffs.
Mm-hmm.
So, tariffs, firstly, tariffs have less effect than people think on inflation. The cost isn't entirely passed through to the consumer. Secondly, the consumption basket of consumers is only about 10 to 15% imports. So that's 10% inflation on 10 to 15% of our consumption basket. Well, that's only 1 or 1.5%. Part of that's borne by the exporters, part by us. And the third thing is he uses tariffs not to saddle the consumer with increased costs of goods and services, but as a blunt instrument to get the policies he wants. He uses
Mm-hmm.
it as a weapon. And that means threatening to impose a 60% tariff and then putting in a 10% tariff is a way of getting what he wants. I don't view the tariffs with great alarm on the inflation front. It can also be offset if regulatory costs. Um, the Biden administration put in place regulatory uh, uh, additions to the regulatory state that I've seen estimates are worth anywhere from $2,000 to $4,000 per consumer per year. That means our national wealth is diminished by that amount. If he reins in the regulatory state, and he's got really skinny majorities in Congress, so this is going to be a heavy lift. But if he reins in the regulatory state in a big way, if the Doge Committee makes significant changes, then the incremental growth can swamp any inflationary pressures. I don't know how this is going to play out. I like 2/3 of his policies. I think 1/3 of them are dumb. The 2/3 that I like, if he gets it done, the economy can go gangbusters. If a skinny majority in Congress impedes his ability to get those things done, then he's got a poison chalice, an expensive market, and an inability to get his agenda passed. So we'll see how it plays out. I'm rooting for Doge to not Dogecoin and not Trump coin, but the Doge committee to have an impact. The state is just getting too big.
All right. We got time for just a little bit of a plug here on something that will give our audience a little more information on this Research Affiliates Deletions ETF. It's an upcoming webinar called it's February 13th at 1 p.m. Eastern Time. It's called Dumped But Not Defeated, Finding Hidden Value in Index Deletions. It sounds like it's going to go into a lot more depth of what we've already been talking about and this NIXT ETF. The panelists on this are Rob Arnott, yourself, Brent Ledbetter, partner and head of solutions distribution, and Wesley Gray, CEO of Alpha Architect. Just real briefly, Rob, what do you kind of expect with that? Is it going to be giving us a deeper dive into the value that can be found in these companies that are kicked out of indexes?
Well, firstly, Wes Gray, as head of Alpha Architect and co-head of ETF Architect, he's brilliant.
Mm-hmm.
He's a dynamo. He's really awesome. There's not a lot of PhDs from University of Chicago in the finance with a finance PhD who run businesses, but he's one of them, and he's an impressive talent. He can talk about the ETF. We can't. Brent and I can talk about the index. And so between the three of us, we'll be able to cover all bases. And yeah, it'll be a deeper dive. It's going to be great fun.
All right. All right. Well, I will put a link to that in the show notes for those of you that want to check it out. And in the meantime, I want to thank Rob Arnott, the founder and chairman of Research Affiliates. I want to tell our audience to go to ETF.com for all of your ETF information. Check out, we've got an advisor center there that's designed specifically for financial advisors. And obviously, you can research Rob's or this Research Affiliates Deletions ETF, NIXT, right there at ETF.com. So until next time, I want to thank you all for listening. And thank you, Rob, for being here.
Thanks for the invitation. This was great fun.